In my mind, the minimum qualifications for an investor in oil and gas directly is probably somebody who's got at least a $3 to $5 million minimum net worth. And if you're going to participate in working it, you better have an income north of $500,000 a year. North, $500,000 as the bottom barrel. What I have now is I got dozens, if not hundreds of wells making me money 24/7. I'm mitigating my taxes. I'm tax deferring the tax I owe down the road. And what Troy has done for 40 years, if I could line up 41 bottles, I've done 41 years of doing the exact same thing. Well, 41 years in the oil and gas business. 41 years representing high income, high net worth investors. I can tell you, looking over a 4-decade career, I've kind of come to my own mind who is or who is not qualified to participate in working interest. First and foremost, it's probably more emotional than anything. There's a reason why 80% of the tables in a casino in Las Vegas are empty. Most people don't like to gamble. Most people don't like to take risks. Most people would rather buy something they can see, touch, kick, or feel. But when I think about what we define as high income earners, I think we have to do it correctly. A high income earner these days is not somebody who makes $300,000 a year. Used to be 15, 20 years ago. A high income earner by the definition of an accredited investor is that I've made $300,000 a year for the last 2 years and I expect to make it this year. That's like having a CB radio. That's like having a black and white TV with foil in the antennas. That's antiquated by today's standard economic values. In my mind, the minimum qualifications for an investor in oil and gas directly is probably somebody who's got at least a $3 to $5 million minimum net worth. And if you're going to participate in working it, you better have an income north of $500,000 a year. North, $500,000 as the bottom barrel. And I'll tell you why. When you think about breaking apart a $300,000 income and you pay for your cost of living, your kids' colleges, clothes, minimal savings, etc., and by the time you get done paying your federal income tax, you might have $75,000 to prudently invest. So out of $300,000 income and $75,000 that you're going to have left to invest, you're going to try to go buy working interest. You're really not qualified, in my view. For you to be able to be successful in working interest, you have to understand what it means to be high net worth and high income. High income needs to be that you have enough money in income per year, whatever that source is, that says, I can take care of my personal needs, I can take care of my vacations and houses, I can take care of my minimal savings in my normal accounts, and I have an excess of cash, excess of income that I don't know what to do with, I don't have a need for it, it's outside the scope of my core investment strategy. Now what I want to do is figure out how to protect it. What's the number one wealth deterioration, period? Taxes. Every time you go to the store and I pay 8% sales tax in Texas, that's lost income, 8% gone. Every time I pay federal income tax, 37% gone. I don't like working until June 15th just to break even by the time I pay my taxes. So if I want my time back, and I want my income back, and I want the utilization of my own money, and not give it to a deep, dark hole called the federal government, I better figure out how to do tax mitigation. So when I think about working interest, I have to decide, how does that look in terms of me being qualified? Well, let's say I make $1 million a year in gross income. I now have a $370,000 obligation. I'm just using straight line 37%. I know there's a step up, but let's just say it's 37% tax write-off or taxes that I owe. I got to figure out, do I want to write the check for $370,000 and give it to the government, or do I want to try to retain that $370,000 and build my assets, build my income, and use my money, my 37%, to make a better return, a 100% return, and a growth asset rather than what I would get from the government, which would be a big fat zero. So how does that relate to working interest? So let me just give you an example. When I go drill a brand new well, the government's going to give me a 100% tax write-off to drill this well and get those reserves in the ground that are today not flowing. It's not a flowing well. They need private investors that qualify as high net worth, high income to participate in the drilling of domestic wells. And the way they reward you is they say, if you'll take, let's say this is a $10 million well, and you'll put in $100,000, what we want to do is give you the chance to reduce your taxes by 100%. You don't owe any taxes on that $100,000. Wow. And what you get today, because of technology, is you got a 99% chance you're going to find oil in the well that we drill horizontally. The question is, does the well have this much or this much? And that could be a function of mechanics, it could be a function of engineering, or it could be a function of how much promote. I'll get to that in a minute. When I think about it, I would much rather take a 95+% success ratio drilling a horizontal well, saving 37% of my income, or $37,000 on every $100,000 of income I make. I don't spend it by giving it to the US government. I spend it by drilling a successful domestic well. And then what I get is I get a well that can last 10, 20, 50 years of economic life. This one was drilled in 1992. This one could have been drilled yesterday. What's the point? This well's still online after 30 years. I got my tax write-offs back in the 90s. I made my money back in about 7 months on that well. That well's still flowing, and here I am 30 years later. Now, how do you really think about that from an investor standpoint? Where do you think you can go? Can you go buy a rent house that pays back in 6 months or a year or 3 years? No. Can you buy a rent house that literally just produces for the next 20, 30, 40 years? No. I can. I can go buy myself an oil well. It doesn't have tiles and toilets and renters and absentees and vacancies, and they rip out my sheetrock. What I have is an oil well produced by major oil companies every single day, 24 hours a day, 365 days a year. I have to decide, do I have a qualification to invest in working interest based on two things? It's not just money. Am I sophisticated enough? Now, that's an abusive word. Telling somebody they're not sophisticated is like telling them that they're not a man, or telling them that they're not tall enough or they're too fat. It's insulting. To an investor, saying you're not sophisticated means you've insulted me. That's not true. The sophistication is your willingness to learn and comprehend the value of investing in working interest and to really understand how the game is played. See, when you play a board game, most people lose because they never understand not just reading the rules, they don't understand the concept and the way the game is played. I'd rather get rid of the rules and understand how the game is played as my priority, because I'll learn the rules as I go. Maybe that's backwards, but that's kind of how I win board games, and I win most of my board games. In my view with working interest, if you're financially qualified, check that box. So the sophistication box, it's a little dicey. New investors, I don't know that well. I can't tell you whether they're truly building an energy asset base for the next 20 years or if it's a one-time need. They got a big check this year, they got tax problem, they want to dump the money in oil and gas, and they never invest again. I don't know that. They don't tell me that up front. But I can determine the sophistication by the approach. I can determine the sophistication by the questions asked. I can determine the sophistication by the way they approach the asset class of working interest in domestic oil and gas. And the way it should work, so you and I both are on the same page, if I am financially qualified and I'm truly sophisticated that I want to learn and educate and comprehend not only how the business works, but I want to understand how the asset class develops over time, now I truly have decided I'm both financially and sophisticated qualified. Let's assume that's you. Then how does it work? Well, today, this year, 2026, I'm going to go drill a bunch of brand new wells. We've got about a $200 million drilling budget this year available for participation by our clients and our own money. We'll go drill $200 million worth of wells. We expect to have every single well successful and productive. We don't expect any dry holes. It's just a matter of quantity and timing. How fast it'll produce, what the quantity is, and what's the total reserves in place. Then I go to 2027, I'm going to drill some other wells, okay? But the brand new well I drill in 2027 is going to come online sometime in the next 12 months from January to the end of the year. But the wells I drilled in 2026, they're still online. But they produced a little bit. Maybe they produced 10 or 15% of the reserves in place. But this well's still online. But now I have a problem. I have the $1 million of income I'm making from my job, my occupation, my business, my other investments. I invested that in 2026 so I could get these reserves, and I got my tax write-offs. But now these wells are now they're producing in 2027, and I got new wells I invest in 2027, they're producing as well. And then I go to 2028, and now I got a three-way stack. I got the older wells from 2026 making money, I got 2027 making money, I got 2028 making money, and it just keeps on going. All of a sudden, I look 5 years down the road, and I've invested $1 million each year, $5 million. I made my money back on year number one. I made that back in 36 to 48 months, but I got that $1 million back. I got to reinvest that. And if I do that over the next 5 or 10 years, I could literally say a $250,000 investment invested every year for the next 5 years ends up being about a $3 million investment, the $250,000 per year, taking the revenue from wells in year 1, 2, 3, 4, and 5, reinvesting that. I got about $3 million invested with a $1.25 million basis, and I got reserves in the ground that are probably worth $6 million or more, according to our calculations. I have reserves left in the well I drilled 5 years ago, 4 years ago, and so on. That is how oil and gas works. And you have to be, or want to be, or try to develop into a sophisticated oil and gas investor. This is not gambling. This is not Vegas. Okay, that's a losing proposition. The tax write-offs are not even what I'm talking about. I haven't even factored that in my equation. I'm just saying drilling successful wells, letting the revenue from those wells compound in addition to my income. And 5 or 10 years out, I got this enormous cash flowing asset pool that's compounding in cash flow, saving taxes along the way. 15% of all the oil and gas I sold, I don't pay taxes on because it's 15% for depletion allowance. And what I have now is I got dozens, if not hundreds of wells making me money 24/7. I'm mitigating my taxes. I'm tax deferring the tax I owe down the road. And what Troy has done for 40 years, if I could line up 41 bottles, I've done 41 years of doing the exact same thing. Taxes I owed in year 1, I pushed to year 2. Revenue from these wells in year 1 and 2, I added to my income, I pushed it to year 3. And I do that compoundingly over the last 41 years, and I've got interest in over 12,000 wells, and I've been pushing tens of millions of dollars of taxes that I owe by using the IRS's rules and what Congress passed in the Tax Reform Act and the brand new one big beautiful bill that President Trump passed. I have all that to my advantage by saying, you get to drill for free. Every time you drill, you get a 100% write-off. You don't pay tax on 15% of your income, and you get to compound that income. So even when the wells are successful, by reinvesting and reinvesting and reinvesting, I keep delaying the taxes. And you might say, well, is this a merry-go-round? When do I get off? It's simple. Year number 4, I'm making a lot of money. And I decide I want to buy a vacation home. I pull out $700,000 or $800,000, and I mitigate the tax by looking at what I'm doing. I'm willing to pay the taxes because that well's already paid out after 4 years. So I can withdraw and pull money to do other investments. I can plan for retirement. I can buy lake houses. I can go on vacations using the income, but I can then manage what income tax bracket I'm in. I can manage when I pull it out. I can manage quantity. What I never do is I never stop building the oil and gas energy engine. That is how you make a lot of wealth and you become a sophisticated and qualified accredited investor in oil and gas. Thanks for listening.